Welcome back to another episode of Singapore's Real Estate Explained, brought to you by the JNA Investments team. And today we'll be talking about how the cut in Fed rates will affect the Singapore's property market.
And yeah, this is something very big news because people have been speculating, say, hey, is there a recession coming? Is there things that are going on in the market that we do not know? And how does it really affect Singapore property market? So what we'll do, it will go back in time.
Yep.
Where we understand how did the market react to all these kind of interest rate hikes, interest rate dip, and what is the future potential, future effect of such a Fed rate cut. Okay, so without further ado, let's jump straight into the topic. Okay, so the first thing we'll run through is what exactly is a Fed rate hike or cut. Okay, so this is something that we are dissecting the fundamentals behind the federal funds. How do they think? Why do they want to reduce interest rate? Why do they want to increase interest rate? Okay, and third, we actually run into what the effect will be for Singapore property market. Okay, this is something that people have been asking us, and this is something we're more than happy to share the latest update.
Yeah. Okay, so let's understand basically what are Fed rates first. I think Fed rates are essentially the interest rate at which banks in the US, they actually lend their reserve, means their extra funds to one another overnight. So it's on a short-term basis. So this actually influences the overall borrowing cost on whether it's more expensive to borrow or less expensive to borrow. And that in turn then affect how the economy actually grows, whether you want it to boost the growth or you want it to kind of slow down a little bit.
Yes, indeed. And a very layman term of understanding this is that imagine now, you have a bank. Okay, you have bank. Bank wants to run their own businesses, wants to run their own operations. So what they'll do is they themselves will actually borrow money from either other banks or even from the Federal Reserve where they get the money from. And this amount of money that is borrowed, okay, will actually be charged with interest rate. So that's what exactly Fed interest rate means.
Yeah.
And how does it really affect us, okay, as consumers is that because when interest rates are high, okay, when Fed rate increase this number, for example, from 1% all the way to 4%, what happens is for every dollar borrow, okay, the costing will be much higher. So when it becomes higher and more expensive, people will then, psychological effect is people don't want to spend as much.
Yeah.
Okay, and that will cause the economy to either slow down a little, but at the same time, it will allow inflation to be curbed. Because inflation is triggered when people overspend, they keep buying and buying, it trigger demand that cause the price of things to rise. Okay. On the other hand, when interest rates are low, when the Fed actually decrease interest rate, naturally it's cheaper to borrow and encourage people to borrow more and spend more, to buy property or buy asset classes, and that itself will help to stimulate economy.
Yeah.
So it's always like a seesaw. It's always balancing between these two particular monetary policies.
So maybe you can also look a little bit on the history of how Fed rates have actually changed. So you'll see that if you look at the past couple of years, right, when COVID hit in 2020, the Fed rates actually almost dropped to 0% because they were anticipating a downturn of events. That's when, they want to encourage spending. That's when they made borrowing very cheap. Yep. Afterwards, you realize that we also had a time where we dealt with inflation. In order to curb inflation, then the Fed says, okay, I'm going to increase the interest rates, make it a little more expensive. So you see that actually throughout a period, right, I think they had 11 rate hikes over the past couple of years after COVID. And this half-point cut that happened very recently is the first time that the Fed rates actually dropped since the whole entire rate hike.
Yes, in fact, not dropped just by a little bit, but significant. 50%, 50-point cuts is quite high. Usually it's about 25. Yeah. And if you look back in the past, most of it had happened in the 2008 period, 2009 period, where the Fed rate cut the interest rate to encourage spending because you know that the economy is slowing down, and there's one more in 2000. So this is something that we will dissect later on, like what exactly is going behind the concept of cutting, and later we will transpose it to Singapore property and how does it affect our prices in Singapore.
Yeah.
All right.
So I think two main things on why Feds are cutting rates is employment as well as inflation. So these are two factors on, or rather two major impacts that would happen whenever the Fed actually increase or decrease the rates.
Yes. So let's take a look at the first factor about inflation. So how does Fed react to inflation? When there is very high inflation, you can see in this chart over here, the blue line represents the inflation rate, okay? The black line represents the Federal Reserve interest rate. So when you see inflation after COVID-19, as I mentioned just now, it went all the way up to close to 9 to 10%, close to 10%, about 9+%. That was when the Fed rate decided that, hey, it's getting out of hand.
Yeah.
Because if things become too expensive, become too unaffordable, it's not good for the economy. Yeah. So what they will do is they will actually do this called interest rate hike to discourage spending, as mentioned just now. Conversely, when there's low inflation environment, like back then before 2020, okay, and the economy is starting to slow down because of COVID-19. That's when they were actually deep interest rate, close to 0%, which is quite rare in many circumstances. And that is when it's to stimulate economy, and the inflation wise is still under healthy level. So it doesn't create a problem for the economy.
Correct. So they basically want businesses to borrow, so that when they borrow, the government say, okay, I'm giving you like free money for you to tide you across. And when businesses borrow, they can increase their business activities, they can hire more people, so the unemployment rate also falls.
Yes, and also they look at inflation, I mentioned just now, to make sure that it doesn't get too high at the start, okay, before they cut their rates. And another data they look at, okay, is this thing called unemployment data. So this is something, it's quite tied to how businesses are doing. So the higher unemployment rate, the likelihood of economic downturn is high. Yeah, so that's when they will start to cut rates. Okay, but right here, okay, as compared to COVID-19, it was one of the worst situation 2020, and unemployment rate actually went up to 14.9%. Okay, record high. And that's where interest rate, that's why it was dipped to zero to really stimulate economy and make sure that people have a job. Okay, and over time, you can see 2021, 2022, this unemployment rate have dipped by quite a lot because the monetary policy did work. People did find a job. People did manage to get the business running. But after that, okay, because inflation started to slow down. Started to slow down. That is when the Fed will say that, hey, I think it's all right for a cut. Unemployment rate, I would say, it's not really a key dealing factor over here yet. Even 4.2 is still a marginal as what they got in 2015, way before COVID-19. So there's something that, once again, they'll look at this two factor to actually decide whether to cut rate or not.
So you will see that actually we've been hearing for quite some time that the Feds are going to cut rate. And, it's been going on for quite some time. And finally, they give the news. So you can also see that they're actually a little bit more careful also on whether to cut. Even though, inflation has kind of settled down, unemployment rates is kind of okay. But they just want to make sure that, it's gonna like these effects will last before they even make any changes.
Yes, indeed. Yeah. All right. So with this, we'll move on to the reason what is the mechanics, okay, when it comes to cutting rates and how does it affect Singapore property. Okay, so one thing to take note that interest rate is very interrelated to is by this thing called money supply. Okay, so how it works is, okay, the concept is very straightforward, is to make interest rate low, to cut interest rate. What they will do is they'll do this thing called quantitative easing, where what government will start to do is to pump in more money supply. Print more money. Because the more money there is, the cheaper money can be to lend out. Yeah. So when there's excess cash supply in the bank, in the Federal Reserve, that's when they can borrow out at a cheaper rate. And that will allow interest rate to drop. Okay. And why is it related to property, and also why we're talking about it so particular about this element of it, is because when interest rate drop, what happens is that there will be greater borrowing for housing loan, and naturally transcend to greater demand and subsequently increase in price of real estate. So one thing to note is real estate itself is I would say inelastic, it's a lagging market. So this kind of effect won't be felt so fast. It's not like stocks where you can buy and sell. It will be, the market can rise at 20% in a day due to speculation. But real estate, this kind of effect will be felt like in longer term. Maybe not so like 1-2 months, but rather next year or a year after even.
It's something that will trickle down, the effects. It's not something that you see overnight happens.
Yes, correct. So that's something that you will be very excited to explore in the later part of this research. All right. And good news is for Singapore, okay, 2024, the money supply flow, not just in US but in Singapore, have been rising. So money have been printed, money have been pumped into the system. And this is something as compared to 50 years ago, you can see, long time ago, 1970s. Money supply is low, it's limited. But after a while, just bring more and more and more money, okay? And that allow the money supply flow to increase by huge margin. Okay, and why is it important to understand this? Well, long-term run, this is one of the key driver for inflation also. But back to interest rate, one thing they use to stimulate interest rate, you can see, as compared to back then in 2020, all the way down 2020, all the way down to 2022, then down 2023, there is actually a slowdown followed by a quantitative tightening where money supply has been kept. But thereafter, they're starting to increase once again. Okay. Then the question is, how does it affect Singapore property then? So what we did is we actually plot the property price index to this money supply flow. And found something that's very interesting is that when there is a huge pump up in terms of money supply, which is actually quite tied to lower interest rate cuts, what happened is the property price index will start to soar, will start to rise. Okay. On the other hand, what we notice is when the money supply flow start to tighten, okay, we don't see a crash in market, but we see a stagnation in prices before right now when there, once again, it's already quite tallied with the uptrend where there is some signs of recovery in the economy. All right. So this is something to summarize is you can see 2016 and 2018, okay, when there is an increase in money supply flow, what happens is the price actually went up. Okay. And then when it stagnate, it just stagnate a bit. And when it boom, I mean in the 2020 during the COVID-19 rate cuts and all the money supply flow that comes in, what we see is the property price starts to rise up rapidly. So it's something that we have been still tracing till today. Okay. So with this, right, before we move on to how does it affect Singapore property today, let's take a look at the past historical trends.
Yeah.
Okay.
So I think a few things that are immediate effects on how Fed rates actually affect Singapore. I think the first few things is your SIBOR and SORA is being affected because they are being tagged very closely to the Fed rates. Of course, SIBOR is being put aside. It's not being used already. Just because Singapore government also don't want us to be too interconnected. That's why they went with the SORA, which is Singapore Overnight Rate Average. So in that sense, we have a little bit more control over the interest rates in Singapore. Of course, there is still some effect that, when Fed rates go down, SORA also goes down. So we are slightly tight in a way that once Fed rate cuts, you expect the SORA to drop. And that also means that your interest rates for borrowing also starts to fall.
Yes, indeed. And this will tie very closely with our property prices because you can see based on past trend historically, most of these changes are directly influenced by Singapore real estate market. Okay, so during times where you can see low Fed rates, you can see right over here, okay, during low Fed rates, okay, what we notice is that property price, okay, will actually tend to either pick up slightly, or rather during low interest rate over here, you can see the property price actually soar up very quickly. Okay, so just in context, how to read this chart is the orange diagram, the orange line over here represents our property price in terms of PSF. Okay, and we superimpose it against our Fed interest rates with SORA and SIBOR, which is right at the one in front, the color. And right at the back, if you see this very big graph, small graphs, these are all transaction volume.
Yeah.
So as I mentioned just now, when Fed rates are low, okay, over here, it does pick up a bit, okay, but when interest rate was suddenly cut, okay, in 2020, you can see the property price actually rose up close to 30 to 40, 50%. Yeah. So there's something that we have to take note. On the other hand, interestingly, we also notice interest rates. If the interest rate stays high, you see there's a hike in interest rates. Interestingly, what happened we see over here, despite the hike, the price did went up, but it did not go up as fast. But when interest rates stay high for a moment of time, you can see, which is over here in 2023 to 2024, the price itself also starts to stagnate and slow down.
Correct. So I think one interesting thing is that if you look at the background, the blue side, right, the volume did kind of fall, but price-wise, they didn't really fall in correlation to the volume. It kind of stagnates, but that's when the volume falls. So I think Singapore, it's a very unique market where, yes, we are slightly affected by external factors, but because of the fundamentals of the cooling measures or measures put in place by the government, you'll see that when things happen, Singaporeans are in a wait-and-see approach.
Correct.
So demand or supply may kind of be a little bit more stagnant where, buyers are waiting out, sellers are also waiting out. But sellers are also not in a rush to sell. They say, if I cannot hit my price, I'll just wait for a while more. Then buyers will be like, okay, I'm expecting like a drop in interest rate, for example. Maybe I'll wait out the market a little bit. But when you see things happen, that's when market moves very fast also.
Yep. So it's either a standstill or
correct.
A sudden hike in prices. All right. So with this, okay, let's understand, okay, go to the micro now.
Yeah.
Understand how does the drop in interest rate really affect on a micro level in terms of market-wise, the current market? Okay, so one thing that you take note is, I said, it's cheaper to borrow money.
Yeah.
Okay, which you can see right over here. In terms of a person, okay, monthly mortgage for a $2 million resale property. Okay, back then, okay, during the interest rate hike, okay, there was one of the peak about 1.5 years ago. Interest rate was about 4.25%. Okay. with this 2 million resale property with 75% loan to value, the mortgage paid per month is about 7,003. Okay, of which you can see almost 70% goes to interest.
Yeah, that's a scary part, right?
Yeah,
5,003 is thrown a sea money.
Yes, and only 2,000 used to pay down your loan every
Yes.
month. Okay, on the other hand, if we compare back to in 2020, okay, when the market really, really went down, the interest there's negative in some places or even close to zero. Okay, some places like other countries, but close to zero. What we see is 1.25%, which is a fixed rate that was back then. The mortgage is actually close to 40% lower. Okay, so it's about 5,000. And the beauty is interest is of course 3 times lower. But principal, most of the money they pay per month is used to pay down the principal. And now we're actually at 2.8%, where the mortgage month is about 6,000, about close to 20% higher when it was all-time low, but slightly about maybe 10 to 15% lower than when all-time high. So once again, this itself, the principal is 2,663, interest is 3,005. Okay, so why the rationale, why we're looking at this is because you must understand how sensitive is a loan mortgage, okay, when it comes to a change in interest rate. And by affecting how much you pay per month, okay, it does affect our borrowing power. When people feel like, during low interest environment, I can pay 5,000, they don't expect it to go high.
Yep.
But on the other hand, when the high interest rate environment, okay, when there's a cut interest rate, you feel, I save a lot. It's actually cheaper and I'm willing to buy more or I'm willing to afford higher property prices.
So I think it's important to look at your mortgage from 2 points of view, which is your principal and interest, right? Is that, okay, when you see 7,000 to 6,000, 7,000 plus about 6,000, I think, okay, the difference is about 1,000 plus from a mortgage point of view. But you have to also go and look at your principal and interest, is that the biggest jump is on the interest part, because the differences in interest, which is basically your cost of holding on to this resale property, right, drops from about 5,000 to about 3,005 in today's market.
Yes, indeed. And one thing to note is a lot of people have misconception. They say if interest rate increased by 3 times, the mortgage increased by 3 times. It's not true. You can see this is almost low to high is almost 3 times.
Yeah.
But the increase is only about close to, I would say, 50% more.
The jump is in the interest part.
Yes, but jump is more
so
in
you
the
basically
interest
pay,
portion.
but less principal is being paid down.
Yes, indeed. So in terms of Singapore, unlike other countries where maybe interest only, where a jump in interest is really 3 times, 4 times, they can't afford it. But Singapore, a jump in interest or deep interest doesn't create that very huge difference in terms of mortgage amount that cause a lot of struggle when it comes to paying now. Yeah.
Okay. So moving on to the next one is that the drop in interest rate, it also leads to higher borrowing power. Or rather lower stress test. So you can understand it as even though current market interest rate is, for example, 2.8, when you go to the bank and ask them to, can you do up a loan eligibility for me, they won't use 2.8 because government's policy is that the bank always has to use a stress test, which is usually a higher amount. So maybe, for example, 4.8%. Yep. This is just to protect in a way that if let's say today is 2.8, but let's say tomorrow, for any reason, it just jumps to 4.8, you will still be able to afford the loan. So that's another measures that are being put in place by the Singapore government to say that, okay, if there's a downturn in events, market's not doing very well, interest rate goes up, Singaporeans are still able to pay off their mortgage based on a higher income or higher interest rate.
And not just that, they actually have only can use 55% of their income to pay off the loan at a 4.8% interest rate stress test. So it's a very safe buffer as compared to our 20, 30 years old where there's no such ruling. So they give even a greater safety buffer to the borrowers.
Yeah. So to look at it with the numbers being broken down, let's say you're earning 16K income and you're 30 years old. If the stress test is 4.1%, you're able to take a max loan of about 1.8 million, which allows you to buy a property of about 2.4 based on 75% LTV. If let's say stress test increases up to about 4.8%, which is like today's market, your max loan goes up to about 1.6 to 1.7 million. And then property price that you can afford is about 2.3. So you'll see the differences in stress test between 4.1 and 4.8, right? Is that the loan difference is about 150K and your property price difference is about 100, almost close to 200K. So every time an interest drops, people borrowing power increases. So it means they can afford, or rather they can afford to offer a little bit higher also.
Yes, indeed. And not just, this is 0.7%, it's 200K difference in offering price.
Right.
So there's something that we do notice in terms of the market-wise. Once interest rates start to drop, people feel like I can borrow more, I can buy more, why not I try something higher?
Correct.
So it does stimulate the economy in terms of the housing market. All right. So with this, okay, the conclusion that we have is that what exactly entails for the future. Okay, people say Fed rate cut is a good thing. Well, there's only one thing that we look at. There's a lot of aspects that we look at. But let's go back to the key idea. Is the interest rate going to rise or fall in the next quarter or the next 1 year? Okay, so as I mentioned just now, because inflation is coming down, okay, the inflation from 9.1% and dipped to almost 3+%, closer to hopefully hit 2% soon. What the Fed rate have mentioned since long time ago is they are going to cut the rates. It's definitely going to be on a downtrend, but this is first time they've effected to action to cut 50 basis points, and this may how fast they cut will also determine how it will exactly affect the real estate market. Okay, but of course, one of the counter argument, I mean, reading some news and understanding what exactly are some of the people's worry in the market, is that the real estate market interest rate cut is one thing. Price may seem okay, projected technically it should be increasing
because higher borrowing power, lower borrowing costs.
Yes. Yeah. But one thing that people did mention, I mean, there been, I say speculating or saying that you notice over here, whenever there's a huge interest rate cut, okay, in 2001 during the dot-com bubble burst, okay, 2008 global financial crisis, okay, and there's a very mini one over here, COVID-19, which didn't happen. It was just maybe a few months and things were gone. Okay, so when some people speculate, say that, hey, if there's an interest rate cut, okay, does it signify a recession coming? Will it crash the market? So these are perception that we do take into consideration to understand. Okay, but one thing that I noticed, okay, when you run to this particular speculation based on past trend, you must understand the context of what happened back then wasn't because interest rate dropped, recession came. It was actually the converse. Recession came. That's why interest rate drops.
Yeah.
We should understand in 2000, dot-com bubble, it burst at 2000, the peak. Business were already going down. Things were going downhill. Unemployment was sky high, skyrocket. That's when the Fed decided to cut interest rate to salvage. Another situation, Lehman Brothers, 2008, when the market went downhill, the Lehman Brothers bankrupt, went to very dire situation. That's when interest rate also cut. Is a response to that.
Yeah.
But so today, a lot of people say, is this interest rate cut? Is this another sign? It's once again, it could be another like COVID-19, 2 months. Done. And one thing that we do trace is about the employment rate, which you can see last time it's only 4. So it's still healthy. And of course, once again, the total of other things that we do consider, like government policy, Singapore context, supply and demand, economic factors, and what are the global markets handling right now.
So I think there are many other factors that is never one to just look at one factor on how property market goes, right? It's always a combination of factors. If let's say government policy suddenly come in, they have a cooling measure. Even though your interest rate is low, it may not necessarily mean that your property price is going to go up. So I would say at every timeline, right, property market is very heterogeneous. So every unique factor plays a very big part in it. So I would say that there's one factor to follow, but you have to also take a look at the overall to see, okay, how's my supply and demand? You know, is the government releasing more land, less land? How's my GLS going? These are a few factors that you also have to note.
Yes, indeed. And the key thing is, the best part is, within all this chaos, okay, people who have speculation, fear, are we able to find a good value deal, which is always, I would say, there's always one or two in the market, or rather a selection of few that we are able to buy below market value. So even if the market were to have a correction, we are still able to buffer it and subsequently ride the wave up in the next 3 to 4 years. So it's always understanding that particular heterogeneous factor rather than considering the fear in the market, things are going down. In fact, fun fact, recently this came from a good class bungalow viewing, and we noticed that recently all the bigger players have started to move. They are starting to come into the landed market. There are coming offers. I mean, before interest rate hike, I mean, it was quiet, very quiet. And this interest rate hike, you got like 3 to 4 offers just within like less than 1 week. And these are some things that in the market, the bigger players have seen. They know that as compared to other markets, okay, which may be volatile, things are uncertain, there's oversupply. This market by itself in Singapore, because of scarcity of land, has something that we should be looking into to understand what exactly is which. We won't be coming today because it's a very big analysis about supply and demand analysis, but there's something that we hope to add more value along the way. Okay. And to wrap things up, okay, the last thing we'll take a look at is a worst case scenario. If market really crash, okay, what will happen to Singapore property market? Okay, that's something that we do consider also. But even you see, one thing that we trace very carefully, we're always looking at it, which I'm repeating multiple times, is the Singapore property bubble, which is actually on the low side. The green side 0.5. Okay, the higher this number, the more likely you have property bubble. But the property bubble had been shrinking 0.5 to all the way to 0.47. As compared to other areas like Zurich, Tokyo, where things are overly expensive, there's a bubble. Singapore is considered as, I would say, at value, or even some cases, people have undervalued. Yeah, that's why this is something that we notice, and even during COVID-19. Okay, US unemployment rate shot up to, GDP dropped to 32.9%.
Yep.
Unemployment 14%. In Singapore, we also see there's a drop in close to 11%. It was a very dire situation actually in COVID-19. But what we noticed is the pricing still continue to climb. Okay, COVID-19 all the way up. And the rationale, once again, we should end it off in the worst case scenario in Singapore, unlike other countries where there's over leverage.
Yeah.
After TDSR is out, okay, what we see is the economy has started to stabilize. And we notice that people start to over leverage and borrowing way beyond their means. And that's when they can still afford and hold the property even during the downtrend.
Yeah.
So there's something that gives us a sense of support and safety that allow us to know that even in downtrend, a lot of them, the fire sale is not something that is within their idea. They'll just think that, okay, things are bad, I can still pay all my loan, let us continue.
Correct. I think to put into perspective, you can see it as, okay, with ABSD, last time people can hold like 6-7 properties. If anything happens, they cannot pay off their mortgage, they have to fire sale, and that's when the property market crash.
Yep.
I think with the ABSD, everybody can hold one. And it's like, if let's say the market don't do well, you won't hear your parents say, hey, faster go and sell your house.
Yes.
Because that's the only house that you are staying in. So with all these measures of TDSR, ABSD, right, that's why you will see that Singapore market not as volatile as in the past. That even though, yes, things happen, what you'll notice is that a correction happens, the market slows down, the volume stagnates, but unlikely you'll see a huge crash unless everybody fire sale.
Yes. So for now, I would say downside is low. People are more defensive in the first place.
Yeah.
But upside wise, if the interest rate were to dip even more in the next 1 to 2 years, this is something that by the time we catch the trend, the price will have shifted. So there's something that we do notice this particular movement in the market right now.
Yeah.
All right.
Okay. And I think with that, we've come to the end of this video. We hope through this video, you can understand a little bit more on the Fed rates cut. How is it going to be exactly affecting the Singapore real estate market also.
Yes, indeed. And we hope that with this, we at least have a deeper insight about how exactly do you link interest rate, the money supply, down to why they cut, and also how exactly does it affect the property market in general.
So if there is any other topics that you'd like us to touch on or do a little bit more research on, let us know in the comment section also.
And yes, and last but not least, we also have a new launch guide right over here, top 100 new launch. If you're keen to find out more, do scan the QR code and we'll get the relevant investment consultant to reach out to you. All right, so with this, we'll come to the end of this video. I hope you enjoy it. My name is Christian.
This is Grace, and we'll see you next time. Bye-bye.
Bye-bye.